From January 1st, 2026, American insurers could start attaching a new page to a commercial general liability policy. It carries a form number CG4047 and a title, Exclusion, Generative Artificial Intelligence. Under it, 3 lines: bodily injury, property damage, personal and advertising injury, all of it removed wherever the harm arises out of generative AI. It only bites if your carrier attaches it. Nobody voted on that. It is not a law, not a regulation, not a court ruling. It is a printed option attached quietly when a policy comes up for renewal, and it speaks to the question that tends to get left open until it actually happens. When one of these systems causes a loss, who pays? In 2026, that stopped being theoretical. In the first half of 2026, investors filed 121 securities class actions, 15 named AI, 13% of the cases, and 73% of the money. $385 billion out of 529 on Cornerstone's Disclosure Dollar Loss Index. It measures the market value defendants shed across the class period. It is not damages awarded, and it does not prove the AI claim caused the fall. A small share of the filings, a large share of the value at stake. Somebody is on the receiving end of that. In the United States, about 1 business in 5 now uses AI in an actual business function. In finance and insurance, closer to 1 in 3. Those firms face renewals, and what they are covered for depends on their own policy wording and their carrier. How did the industry get here? In February 2024, a Canadian tribunal ordered Air Canada to honor a bereavement fare its own chatbot had invented. That same month, the engineering firm Arup lost $25 million in Hong Kong on a video call where everyone except the victim was a deep fake. Then in March 2025, a Minnesota solar installer sued Google for at least $110 million after an AI summary told searchers the state was suing it. It was not. The Attorney General had sued 4 solar lenders. Wolf River Electric was not among them. The company says a customer read that summary and canceled a $150,000 contract. Google denies the claim, and the case is still running. Here is the awkward part. Losses like those did not arrive labeled as AI. Some of that exposure may sit inside policies written before anyone thought to name the technology, so whether it is covered turns on the wording and on the facts. The industry has a term for that ambiguity: silent AI, risk that was never named or rated in the standard form. CG 4047 gives carriers a new explicit way to exclude generative AI, so the carriers started asking. In November 2025, the Financial Times reported that 3 large American insurers had gone to regulators for permission to stop covering it. AIG, Great American, W.R. Berkley, whose proposed wording was the broadest of the 3, any claim arising from artificial intelligence in any form. AIG said it had no plans to use its version yet, and filed for it anyway. Pooling works best when the losses are not too tightly correlated. Your warehouse burning down tells an underwriter little about mine, which is why 1,000 small premiums comfortably cover the few fires that actually happen. Correlated risk is not uninsurable. Insurers write hurricanes. It just needs models and far more capital held behind it. If 10,000 companies route their customer service through the same model, and that model has the same flaw, correlation can tighten in a way that is hard to price from the loss history available so far. It is a differently shaped risk, one that may require different models and more capital behind it. Aon's head of cyber put a number on it for the Financial Times. The industry can absorb a $400 million failure at one company. What it cannot absorb, he said, is the same failure at every company on the same afternoon. There is a second problem, the one underwriters in that reporting keep circling back to. Pricing wants a loss history and an explanation, and shared model failures offer thin versions of either. One underwriter told the Financial Times the models were simply too much of a black box to underwrite. So what does that page really do? An exclusion does not remove the risk, it moves it. Once the endorsement is attached, the loss lands on the company that deployed the model. So the decision to put AI in front of customers picks up a balance sheet question. Can you carry a claim? Your policy will not. Firms with more capacity can retain more of it. Firms with less may delay, narrow what the system is allowed to do, or go looking for cover elsewhere. Buying the cover instead is possible, but the market is small. Munich Res HSB launched a small business policy on March 18, 2026, and at Lloyd's, Miller writes AI liability backed by the syndicate Chaucer. The specialist insurance press puts published limits at around $2 million at entry, $25 million for a single organization, and $50 million at the top of the reported range. Now hold that ceiling against Minnesota, where the damages alleged in a pending lawsuit start at $110 million. The reported ceiling sits below the floor of a claim already filed, so the cover comes back smaller and with conditions. An affirmative AI policy is underwritten, which means an insurer can ask questions before it offers terms. Who reviews the output before a customer sees it? Are the logs kept? Is the system tested for bias? Questions and outcomes vary by product, but the shape is familiar. Answer well, and you may get a quote. Answer poorly, and you may get a higher price, tighter conditions, or nothing. Nobody passed a law requiring any of it. An underwriter simply made it cheaper to have, which turns out to be quicker. The European Union spent more than 2 years drafting an AI liability directive, a common rule for who pays when one of these systems causes harm. On February 11, 2025, the Commission listed it for withdrawal, no agreement. ISO made the private form available for carrier adoption on schedule. There is a precedent here. In 2017, malware called NotPetya tore through the world's shipping and pharmaceutical firms. Merck claimed $1.4 billion from its property insurers. The insurers called it an act of war and refused. And while that fight was still running, the market moved anyway. From March 2023, Lloyd's required its standalone cyber policies to exclude state-backed attacks. The Merck case settled the following January. Cyber insurance did not die. It became a market with a known edge. That is the useful way to read a form number. An exclusion is not really a refusal to cover something. It is a market saying, in public, where it stops. For AI, that edge is being drawn right now in filings that almost nobody reads. What the evidence supports is narrower than the headline. Some standard liability cover can now be narrowed or excluded, and the affirmative products anyone has documented are smaller and conditional. It does not show a market-wide withdrawal, and it does not show that adoption has slowed. On the numbers, AI use remains around 1 business in 5 nationally. And this is what would change my mind. If affirmative limits reach the billions inside 2 years, the constraint I have described was never binding, and I will have overread a paperwork change. If it does bind, you would expect a sorting mechanism underneath the announcements. It would matter least where losses are small and cheap to argue about. Marketing copy, ticket routing, internal summaries. It would bite hardest where they are severe, regulated, and hard to price, in credit decisions and in medicine. That is a forecast, not a finding. Those sectors also face independent constraints, regulation, operational maturity, cost, and demand that can matter regardless of insurance. Insurance would be one more weight on that scale, and the one nobody is watching. And none of this is anybody's plan. There is no meeting where the industry decides which parts of the economy get to use artificial intelligence. There is a form, a renewal date, and a signature, which is usually how these things actually get settled. So here's what I would like to know. When your employer or your bank or your doctor's practice finally does or does not switch on an AI system, did anyone in that room ask what the policy says? Tell me below. It is the least glamorous question anybody could ask, and I suspect it is the one quietly doing the deciding.